All right, well, this will be a little walkthrough of some of the application exercises for Chapter 5, just to add some verbiage to what you see in the workbook. So we'll start on question 1. So question 1 is a situation where on April 13th, a group of 8 friends started a private corporation called Lucky 8. They paid $2,000 for incorporation legal fees to form and register the corporation. We're asked to record the journal entry under ASPE. So under ASPE, it'd be as simple as debiting the organization costs of the expenses that they incurred and crediting cash. And these are just simply to record the costs incurred in organizing the corporation. Hopefully relatively straightforward at this time. Question 2, we have a situation where Ernestine Keplinger and Company began a new public corp. The corporation's common shares have no par value, and during the first month of operations had the following share transactions. So on May 1st, they issued 10,000 common shares for $100,000 and were asked to create the journal entry. So they collected cash from the shareholders who invested worth a debit of $100,000. And they will credit the common share account to set up the equity for those shares being issued for the $100,000 for the 10,000 common shares that were purchased. On May 1st, same day, they issued an additional 10,000 common shares in exchange for land in a building. And they were estimated that the market value was $60,000 for the building, land, and $50,000 for the building. So because we know the market value of the assets that were provided to the corporation, we will debit those said assets, land for $50,000 and land for $60,000 and building for $50,000 based on the fair market value, which totals up $110,000 credit to common shares being the value of the assets that were provided to the organization. And however, they were provided 10,000 common shares for the 110,000. Next is the lawyer that handled the issue of the shares sent a bill for 5,000, and they agreed to accept 500 common shares instead of being paid cash. In this case, because it's an expense, it's an operating expense of the organization, debit will be to legal expense because you should have paid the invoice with cash in theory. But instead of cash, you're paying them with the issuance of common shares. So it'll be a debit to legal expense for $5,000 and a credit to common shares for $5,000. And this is to pay the lawyer's fee with 500 common shares. So if you add them up, so far we have 20,500 shares. So then a little analysis we're asked, in the case of non-monetary exchanges of assets or services issued for shares, a private corporation can choose to evaluate the fair value of shares with 2 options. They can look at the fair value of the assets or services, or they look at the fair value of the shares issued. And let's think of a scenario where option 1 is preferred over option 2. And very often, option 1 would be preferred when there's a reliable fair value or market value of the assets or services. And yet, sometimes the fair value of the shares can't be determined. For example, in a private corporation where the shares aren't publicly traded, you wouldn't necessarily know what an appropriate market value is for the shares. Let's move down to number 3. We have Swan River. They were formed on January 1st, 2020, and its common shares have no par value. During 2020, the following share transactions occurred. So we have 4 transactions. On January 1st, we issued 10,000 common shares for $2 a share. So to record the journal entry there, we received cash because we actually issued them externally for $20,000, being 2 times 10,000. And we'll credit the common shares for the $20,000 to issue 10,000 shares. May 15th, we issued 4,500 common shares for $275 a share. 275 times 4,500 shares equals a debit to cash of $12,375 and a credit to common shares for $12,375 based on the share value at that time. On July 1st, we issued 5,000 common shares in exchange for equipment with a fair value of $14,500. So we know what the fair value is for that asset. We will debit the equipment asset for $14,500 and credit to common shares for $14,500, and that is to issue 5,000 shares for equipment. And September 26th, we issued 2,800 common shares for $250 a share. So 250 times 2,800 equals $7,000 debit to cash and a credit to common shares. And that's to issue 2,800. Part B here is a very common table you should get used to creating if you haven't already. In future or other accounting courses that'll come up, you'll actually have more complex ones. So we've introduced this now. And we're asked to determine the total number and value of the common shares by completing this table. So every time there's a share trade, either a sell-off or an addition, you will update this table. So initially, January 1st, we issued 1,000 times $2 for 20,000. May 15th, we issued 4,500 at $275 for a total of $12,375. July 1st, we issued 5,000 shares at an average price of $290, which we get by taking the $14,500 fair market value of the equipment divided by the number of shares. The value assigned to those shares based on the fair value was $2.90. And lastly, September 26th, we issued 2,800 shares at $250 for a total of $7,000. So our total shares issued as of December 31st, 2020 were 22,300 shares for a total of $53,875. And they have what we call a weighted average value per share of $2.42. All right, so let's suppose that Joe, the president, owns 14,500 of those outstanding shares. And what percentage of ownership does he have? So when it comes to common shares, each share has equal amount of ownership, regardless of how much they paid. So in this situation, if Joe has 14,500 of the 22,300 shares, that represents a 65% ownership, otherwise majority. So basically, whatever he votes when it comes to voting time would be the outcome, assuming that 50% or more, or 51% or more could make that decision. I will say in real life, sometimes you need a 2/3 or 3/4 vote to pass something. Not often, but sometimes. Let's scroll down to number 6. So number 6 says on November 1st, Mystery Inc. declared $850,000 of cash dividends to shareholders who were on record on December 15th. Cash is paid to the shareholders on January 15th. Outstanding are 220,000 common shares worth $2 million and 30,000 $4 cumulative, the keyword cumulative, preferred shares worth $3 million. No new shares were issued during the year, and dividends were last declared in 2016, being 4 years earlier. Mystery had retained earnings of $4.5 million and earned a net income of $1.2 million in the year. So the first thing is, because we have cumulative preferred shares, we need to determine how much or how many dividends are owed to the preferred shareholders. So we haven't paid since 2016. So we have 17, 18, 19, and the current year, 2020. We look at how many preferred shares there are. There are 30,000. And the cumulative dividend is $4 per year. So each year we have $120,000 owing for those 4 years. So the first 120 times 4 years, or 480,000, is owed to the preferred shareholders. So in this situation, on November 1st, when they declare a total dividend of $850,000, which is a credit to dividends payable, to liability, they have not paid it yet, the debit to cash dividends will be split between preferred and common. The preferred portion then, because they're cumulative, would be the debit for $480,000. And then the balance of the $850, because it doesn't say they're participating preferred shares. That means any excess dividends declared over and above what is owed to the preferred shareholders belongs to the common shareholders. So there'll be a debit to cash dividends for common for $370,000. On January 15th, when they pay those said dividends, they will reduce the liability a debit for $850 and reduce the cash with a credit for $850,000 to record the payments made. All right, let's look at number 10 as another example. we have this hockey place, paraphernalia place. They have 50,000 common shares outstanding. On January 1st, 2020, the organization declared a 20% stock dividend. And we're asked to prepare the journal entry to record the declaration and distribution. And the market price on the date of declaration was $15 per share. So on January 1st, when we declare this 20% stock dividend, we look at the 50,000 common shares times 20%, so 1/5 is 10,000 shares, times the market price on the date of declaration, because that's the value that the market has determined for the common shares. So we'll have $150,000 being the value. We will have to pull that from retained earnings in this example, a debit to retained earnings, and a credit to common stock dividends distributable to $150,000. Then when they go and distribute those common stock dividends out to the shareholders at the date that's stated, they would then move it or debit the common stock dividends distributable account and credit the common shares, because now they've assigned it to the various shareholders. Let's go down to number 12. Hopefully this one's pretty short. December 31st, Schuster Home Decor has accounting income before income tax of 102, and we're asked to record the income tax expense journal, assuming that the rate is 30%. We're also assuming that the income tax amount calculated under ASPE, I just realized the textbook has this backwards, ASPE, is the same as the amount calculated under tax law, so there's no timing differences. So in this case, you take the 30% times the 102 pre-tax income to create an income tax expense debit of $30,600 and a credit to the payable for $30,600 because we have not paid it yet. We're setting up the liability at year end. I'm going to pause for a second. All right, so question 13. We've got an extract from MC Consulting's pre-closing trial balance from the year, and the company's net income for that year was $82,000. You see the details on screen. So we're asked to prepare the closing entries using the income summary method. So hopefully you recall that from Accounting 1100, and that's where we close revenue out to income summary, expenses out to income summary, any withdrawals if there were any, which we're not given any, and then you close that income summary out to retained earnings at the end. So I've got it all displayed on screen. I just split the screen here so we can have all the details on here. So December 31st, then we will need to debit the sales revenue in order to clear it out for $240,000, crediting the income summary. For all of the expenses, we have COGS, salaries, rent, and income tax expenses. So we will credit each of those for their values being $85,000, $50,000, $10,000, and $13,000, with a total debit going to the income summary of $158,000. That will net to the $82,000 net income for the year. The last journal entry then to do the closing entries would be on the right-hand side of the screen, debit the income summary for $82,000 and credit retained earnings to record the net income for the year of $82,000. I'm going to move down to 14. Actually, that's all fits here. All right. So question 14 shows the shareholder equity section of Thomas Inc.'s balance sheet as of March 31st, 2020. The preferred shares have an average issue price of $5, common shares average issue of $3, and we're asked to fill out the gray areas. So they are filled out right now. We'll walk through the calculations. First is you take the preferred shares at 23,000 shares issued, it says, times the $5 average issue price would be 115,000. Common shares, 40,000 shares, times the average issue price of 3 is 120,000. So we take the 120 plus the 115 plus the 7 contributed surplus equals 242,000. We're told what the total shareholders' equity is, so therefore the difference must be retained earnings. So take the 533,675 plus the total contributed capital of 242,000 equals a retained earnings as of March 31st, 2020 of 291,675. So a little analysis then in this situation is we have a corporation that has the choice to issue only common shares or issue mainly preferred shares. And all corporations must have at least one class of common shares outstanding. So there must be some common shares. If you were a director on the board of a newly incorporated corporation that's quickly growing and is planning to issue shares to the general public, what type of shares would you suggest? Typically, management would only issue common shares to the public, and that's largely due to the fact that the corporation is quickly growing. It needs to retain as much profit and retained earnings as possible. So that's how they build equity and reinvest in their organization. And with common shares, dividend payment is not the main purpose. Typically, it's talking about growing value of the company over time. Versus preferred shares, typically it's for an income stream. So you're required to pay dividends on a regular basis or expected to pay dividends. Because we're only issuing common shares, we can choose not to pay any dividends out in the near future and keep that cash to continue growing the equity of the org. Let's go down to number 16. I'm going to split screen again here. Because I don't think it'll quite fit. All right. So 16, we have this company, Enigma. It's reaching the end of its fiscal year, and it has declared the following dividends. It has a 10% stock dividend on common shares and a $20,000 cash dividend. The following information is also available. There are 10,000 common shares outstanding, which were issued at $12 per share. There are 1,005 non-cumulative preferred shares outstanding. Common shares are currently trading at $10, and for both dividends, the date of declaration is May 21st with payment May 31st. They also had income before income tax of $55,000 and income tax expense of $10,000 for the year. We're also told the balance of the retained earnings at the beginning of the year was on $123,500. So we're asked to prepare the various journal entries. So starting with the common stock dividend, we look at the number of common shares being 10,000. A 10% stock dividend of 10,000 is 1,000 shares issued, and they're issued at the current market value. So we take the 1,000 shares times the market value of $10 per share to create an entry from retained earnings debit of $10,000 and a credit to common stock dividends distributable for 10,000. So again, it's 10,000 common shares times 10% is 1,000, 1,000 common stock dividend times $10 market price equals 10,000. The second part says that we declared a 20,000 cash dividend. So we have a liability. We credit the liability dividends payable of 20,000. And then we should have an entry to cash dividends for preferred and common. In this situation, we have non-cumulative preferred shares. So it doesn't matter when the last time was that we declared dividends. So we only look at the current year, which has a $5 declaration for preferred shares. 5 times 1,000 preferred shares. The preferred share component for cash dividends is $5,000. The balance would be cash dividends for common, being $15,000 as a debit. May 31st, we then process the payment of the said declared dividends. For the stock dividend then, is we move it from common stock dividends distributable as a debit, and we credit the common shares. So we move it into the equity of the common shares. And on the dividends payable, the $20,000 cash dividends, we would then credit cash $20,000 and debit the liability dividends payable for $20,000. Lastly, we're asked to record the income tax. So we have income tax expense debit for $10,000 and a credit for the income tax payable because we haven't paid it yet of $10,000. The last thing we're asked to do here, or the next thing we're asked to do here, is to determine the retained earnings section. We're told the opening retained earnings was $123,500. We have to add the net income for the year, which was $55,000 before income tax, less the $10,000 in income tax expense estimated is $45,000. Then we would subtract the dividends, being $5,000 for preferred, $15,000 for common, and then $10,000 declared as a stock dividend. So our retained earnings as of May 31st, 2020, a year later, is calculated to be $138,500. Oops. Scroll down. And the last thing we're asked is identify where each of the following accounts will be found on the balance sheet. And the first one we did. So cash, for example, is a current asset, it's very liquid. Common shares is found in the shareholders' equities. This is just helping remind us where they're found on the balance sheet. Dividends payable is in a current liability. It's expected to be paid within the next year. Retained earnings is obviously within shareholders' equity, as well as common stock dividends distributable. So once you've declared the stock dividend, it goes in the equity section, okay? And then once it's applied to the common stocks, then it moves between those two accounts in the shareholders' equity. All right, we're going to jump down to 19. All right, so in 2019, actually, let me pull up the other piece. Okay, so 2019, we have a bunch of transactions on the left-hand side of the screen. I've got the journal fully displayed on the right-hand side. So in 2020, Joanna and some of her friends put money together to start a company called Buds. On January 1st, the corporate charter authorized $76,008 cumulative preferred shares and unlimited common shares. So they authorized, did not issue. On January 6th, they issued 231,000 common shares at $15 per share to Joanna and some other investors. So to record that transaction on January 6th, we would have received cash, so debit the cash for the value of 15 times 231,000, which calculates $3,465,000 as the amount of cash received. And then the credit will be to common shares because we've issued those common shares. January 7th, we issued another 450 common shares to Joanna in exchange for her services in setting up the corporation. And they estimated that her services were worth $6,750. In this case, they're considered organization costs, they're startup costs. So it's a debit to organization cost for the value determined, being $6,750, and a credit to the common shares for $6,750 for the 450 shares provided. January 12th, we issued 3,900 preferred shares for $321,000. So we have cash in our possession for $321,000, and we have a credit to preferred shares as an equity for $321,000, 3,900 shares. January 14th, we issued 10,000 common shares in exchange for equipment. Fair value market equipment, you couldn't determine. But you knew the market price of the common shares on this date was $19. So we take the $19 times the 10,000 common shares provided, and that determines the value of our equipment. So it'll be a debit to our equipment for $190,000 and a credit to our common shares for $190,000. And that's for 10,000 shares. November 15th, our first annual dividend on preferred shares was declared. So we have to look at how many preferred shares there were, being 3,900. We take the 3,900 preferred shares, that's the only preferred shares we've issued, times the $8 cumulative preferred share amount. And this is the first year, so there's no past amount owing. So 8 times 3,900 will give us $31,200. We need to debit the retained earnings to pull it out of that account and credit a liability called dividends payable that will be sent to our preferred shareholders. On December 20th, when we pay it, we will credit our cash account because we're giving the cash away for $31,200, and we'll debit the liability to reduce the liability for the $31,200 that's been provided to our preferred shareholders. And last entry is estimated income tax of $45,000 is a debit to our income tax expense for $45,000 and a credit to income tax payable for $45,000. Lastly, we're asked to calculate, we're asked to calculate the balance of the retained earnings for the year ended December 31st. There is no opening because they just started their organization. And so we'll have our net income, which we're told is $147,000. Actually, where did I find that? Sorry. All right, oh, that's right, here it is. The net income of $147,000 after income tax. So our add net income of $147,000, that's already net of the income tax of $45,000. And we need to take out the cash dividends for preferred. It's the only dividends paid in the year or declared in the year of $31,200. So our closing retained earnings is estimated or calculated as of December 31st at $115,800. Lastly, we're asked to prepare the shareholders' equity section of the balance sheet. So we need to look at the various components that we've issued. There was nothing opening, so the only entries that affect this section will be on our journals. So here we have the shareholders' equity section of the balance sheet for Buds Corporation as of December 31st, 2020. We will have contributed capital for the issuance of shares. So we have the preferred shares of 3,900 shares issued and outstanding, 76,000 authorized for a value of 321,000 from the January 12th transaction. Then we need to add up the common shares that were issued on January 6th, January 7th, and January 14th for a total value of $3,661,750, and a total common shares, if you look at our list up at the top, of 241,450 shares issued and outstanding, and there were unlimited shares authorized. Adding those two values up, we have total contributed capital between the two share types of $3,982,750. Add in our retained earnings from the previous chart up on the top of the screen here of $115,800. We have a total shareholders' equity for the organization after the first year of operations of $4,098,550. I hope you found some of these verbal walkthroughs helpful. Take care.